Hello guys, Hydrate did come out with this earnings video. Um, got 52 views in 5 hours, not too bad for a little company. I was going to push play and stream it because the more coverage it gets, the better. Let's see what they say. Also, Steve quit his job. Good for him. All right, let's see how it goes.
2025 earnings conference call. All participants are currently all on listen only mode. So please just put a thumbs up in the chat to make sure that audio is working. And perfect. Thank you so much. This webinar will be recorded as well. So if you do have to leave for any reason, not to worry, we will be sending it out. So and no worries about that. And for anyone who couldn't join us as well, we'll be sending it to the shareholder list too. So please be advised that certain statements made on today's call may constitute forward-looking information under applicable Canadian securities laws. These statements involve known and unknown risks, uncertainties, and other factors that may cause actual results to differ materially. Listeners are encouraged to review the company's MD&A and other continuous disclosure documents filed on SEDAR+ for the full discussion of the risk factors. You can find our profile on SEDAR+ as well. This call is being recorded, like I mentioned, so for anyone just joining, or if you do have to hop off, or maybe you're on your commute to work, not to worry, we'll send the replay and it'll be made available to our investor relations website as well after the call. I'll now turn it over to our CEO, Mr. Shane Madden, and of Hydrate Technologies. So we'll just give it probably 1 minute to let everyone else in. I see some people in the weight room, and then Shane, you can take it away for you as well.
Thank you. Thank you, and good morning, everyone. Appreciate you joining us. I want to use the first part of this call to review what we achieved in 2025, why we were able to achieve it, and what it means for where this company is going. The financial results were strong, and I'll get to those in detail. But I think more important story is the structural shift that occurred in the business this past year, and why we're so excited about 2026 and beyond.
I don't know if this is just a call. Oh, it is just a call. All right, so they're not going to be showing any numbers. It's just a. Okay.
For those new to the story,
Okay.
let me ground you in what we've built. Hydrate is a healthcare infrastructure company. We provide complete back-end solution that allows businesses to operate regulatory compliant, direct-to-consumer digital health brands across all 50 US states. That sounds simple, but it isn't. Healthcare is the most heavily regulated industry in the United States, and that regulation differs state by state. Setting up a compliant telehealth operation from scratch with a physician network, a lab testing network, a licensed pharmacy network, electronic medical record keeping, prescription workflows, and the compliance framework to operate within corporate practice of medicine guidelines, both legally and cohesively across all 50 states, takes years and tens of millions of dollars. The good news is we've already built that, and we license it to others. A business that comes onto our platform can be operational across multiple states in a fraction of the time and at a fraction of the cost of building it themselves. That is the core value proposition that we provide our customers, and it is proving to be compelling. Coming into 2025, we had 3 clear priorities. First and foremost, prove that our VSDH1 platform could generate meaningful, repeatable revenue at scale. We launched it mid-year, and the results exceeded our expectations. Secondly, demonstrate operating leverage. We wanted to show that as the revenue grew, the platform economics would hold and drive profitability. We believe we've done that. Thirdly, put the balance sheet in a position of strength. We came into 2025 with just over $1 million in cash. That's not a position from which we felt we could be aggressive. We needed to fix that, and we did. Delving a little bit deeper into each of these. Firstly, our VSDH1 platform After a few quarters of client onboarding, VSDH1 went live partway through 2025 and immediately began generating activity. When a business signs a license and goes through our onboarding process, it gains access to our infrastructure, our physician network, pharmacy fulfillment, compliance framework, patient intake, and all the other components that go with operating a fully functional telehealth brand. The products flowing through the platform include GLP-1 medications, peptides, hormone replacement therapy, hair loss treatments, skincare, and sexual health meds. Everything that falls into the patient-specific self-administered category for longevity medicine. These are high-demand, recurring prescription categories. A patient who starts on, for example, a TRT or a GLP-1 program doesn't stop after one prescription. It can be anywhere from 18 months to lifetime in the case of TRT. So reorders are monthly and scalable. That recurring nature is central to the economics of our licensees, and it flows directly through our platform revenue. From a standing start last year, today we currently have over 12,000 licenses signed across VSDH1. Now, to be clear about what that number means and what it doesn't mean, signing a license is just the start of the relationship. It's not the peak. A licensee that signed in Q3 is still ramping up. A licensee that signed in Q4, for example, is still in the early stages of onboarding. And the revenue generated in 2025 from VSDH1 represents a fraction of what those licenses will eventually produce. That embedded ramp in the existing license base is, in my view, one of the single most important things to understand about Hydreight as we move into 2026. Next, I'd like to discuss the operating leverage we're seeing in the business and how it's already driving profitability even at the same scale we're currently at, even at the small scale we're currently at. In the second half of 2025, post-launch of VSDH1, our revenue grew 157% versus the first half. During that same time, our OPEX increased by only 18%, or to put it another way, in the second half of 2025, we grew revenue by over 16 million, and our OPEX only increased by 600,000. This is the platform model working exactly as it's supposed to. The economics here are straightforward. With our infrastructure built, adding a new partner adds transaction volume, not headcount. We don't rebuild the compliance framework for each new licensee. We don't hire a new physician network. All those operating costs are sunk in at a scale across to help us scale across an even larger revenue base. This operating leverage ultimately flows down into our EBITDA and EBITDA margins, which have more than tripled since we launched the platform. We ended the year with a Q4 adjusted EBITDA margin of approximately 11%, a substantial increase from 2 quarters prior when it was only 3.4%. And what we find so promising is that we achieved an 11% adjusted EBITDA margin so early in our scale up, which means the operating leverage story is still in its early chapters, and it should only improve as we continue to scale going forward. Next, we wanted to touch on our balance sheet and how we've transformed it. We enter 2025, as we said, with 1.2 million in cash and a working capital deficiency. In contrast, we ended the year with 16 million in cash and 16 million working capital surplus. That is a fundamental change in the financial position of this company. We accomplished that through a combination of operating cash generation and disciplined financing, including a convertible debenture that allowed us to invest in the platform and build our cash reserves without excessive dilution. Then in January 2026, we closed an oversubscribed 15 million bought deal financing, which brought our total cash position to over 30 million. That financing was notable not just for the size, but for what it signaled: conviction from institutional investors in where Hydreight is going. Finally, before we talk about the financials, I wanted to discuss what we see as we look ahead to 2026. And I want to be direct about this because many investors have been asking this question. In 2025, we were building and proving. We were launching VSDH1, onboarding initial partners, getting our internal processes in place, building our pharmacy fulfillment, and overall establishing the model. That's a very different phase of the business than where we are now. In 2026, we are operating a scaled, proven infrastructure with over 12 licenses signed, a national pharmacy network, a growing physician network, and a heavily capitalized business to accelerate the growth. The playbook is written, the infrastructure is built. We are now in the phase of scaling it. The biggest driver of our 2026 revenue will not be new licenses. Although we continue to keep our foot down and bring new customers into the platform, of course, it will be ramp up of those partners who are already on the platform will be the primary focus. As those partners build their patient bases, increase their prescription volumes, and expand their product utilization, the revenue per partner grows. This is a compounding dynamic, and we are in the early stages of it. We are also expanding into new product categories, peptides and longevity-focused treatments in particular, that represent the next wave of consumer demand in patient-directed health. Our platform is built to absorb those categories quickly. More accurately, we're uniquely positioned from a healthcare infrastructure perspective to be able to leverage the company and provide an ecosystem that had not previously existed. Once these licensees are on our system, we can offer those treatments to all of our existing customers, effectively providing new categories and revenue opportunities to them and their existing customer bases, which we then benefit from. This also materially increases our customers' reliance on us and their retention on our platform. One thing to note is the longevity medicine industry did not exist 5 years ago. The expansion into peptides is the biggest thing in the healthcare industry for a long, long time. Peptides are growing twice as fast as the overall pharmacy market. 14, as I mentioned on previous communications, 14 of the previously restricted 19 peptides were released on February 27th of this year by Robert Kennedy Jr., showcasing the movement towards the expansion into this area from a government perspective, from an oversight perspective. With over 100 other peptides in clinical trials, this just showcases where this industry is going. When you consider the growth from just one treatment or one peptide, i.e. the GLP-1s in these last few years, you can see where the market's going to go when there's 100 plus on there. Also, one thing to note from our ecosystem is that the GLP-1 represents one particular type of customer. These other expansion into the peptides is going to be for general longevity medicine and all manner of patient-specific needs. So again, the market that has already expanded is going to expand by 100x, and this is where everything is going. So when I step back and look at where we are today versus a year ago, the platform scale, the balance sheet, licensee growth, and the team we've built, I feel very good about what's ahead. But let's let the numbers speak to that. Starting from the top, for Q4 2025, total revenue was 14.9 million compared to 4 million in Q4 2024, representing a growth of 270% year over year. For the full year, revenue was 35.4 million versus 16 million in 2024, representing 121% growth year over year. Our revenue comes from 3 streams: business partner, contract revenue, commission revenue, and pharmacy sales. The largest driver of the growth in 2025 was pharmacy sales, which grew rapidly as VSDH1 became active and began processing prescriptions orders through our network. Turning to gross profit, for Q4, our gross profit was 3.2 million, equal to a gross margin of approximately 22%. For the full year, gross profit was 9 million, equal to a gross margin of 25%. As we expected, our gross margin fell year over year, driven by the shift in our revenue mix. Pharmacy sales, which carry a lower margin, grew significantly faster than other revenue streams as VSDH1 drove major increases in prescription volumes. The effect of this was an overall lowering of our blended gross margin. In terms of total operating expenses, we are pleased at how we have continued to keep these costs relatively flat despite the high growth we were able to achieve. For the full year of 2025, operating expenses were 7.6 million compared to 6.1 million in 2024, representing an increase of approximately 1.5 million. In contrast, however, we realized an additional 19.3 million of sales growth. That ratio is the operating leverage I mentioned earlier. Putting it another way, in Q2 2025, our OpEx as a percentage of revenue was approximately 36%. As of the Q4, it fell to just 15%. As we look to adjusted EBITDA, we're happy to report that not only do we achieve positive adjusted EBITDA in every quarter in 2025, but also that every quarter was more profitable than the last. We ended the year with Q4 adjusted EBITDA of 1.6 million compared to a negative 83,000 in the year prior. For the full year, adjusted EBITDA was 2.5 million versus 136,000 in 2024. Along with that growth was an expansion of our adjusted EBITDA margins. We started the year with a 3.6 adjusted EBITDA margin in Q1 and just ended the year with 11% margin in the final quarter. Given the operating leverage we're seeing in the business, we expect profitability to continue to accelerate as we scale. Now that we've discussed the business and our 2025 results, I want to address our outlook on 2026. To start, I want to reaffirm Q1 2026 revenue guidance. The activity on the platform has remained strong through the quarter, and we are tracking in line with our expectations. In terms of the full fiscal 2026 year, we continue to guide to a minimum of 150 million in revenue. We know that appears to be an ambitious number, but we're highly confident we can achieve it based on everything we know about the business today and what our pipeline for the remainder of the year looks. The drivers behind the guidance are not speculative, as we've covered previous. They are the ramp we are seeing in our existing 12,000+ licensed partner base, the continued onboarding of new partners, and the increased per partner revenue as patient volumes and prescription utilization grow. We're not in a position where we need to discover new customers or build new products or build an infrastructure from scratch. The foundation is already in place. It is a matter of execution, and execution is what we've shown we can do in 2025 and previous years. In closing, I'd like to thank everyone who joined today. We enter 2026 well capitalized with a proven platform, a large and still ramping partner base, and a clear line of sight, continued growth and profitability. We look forward to updating you on our Q1 results very shortly, and I'd like to say thank you for joining.
Thank you so much, Shane. Thank you everyone for joining today's call. A replay will be available to everybody on Hydrate's website and the investor relations section of hydrate.com. And we will also be sending an email to everyone with the recording as well. So thank you very much for joining us today, and we wish you guys a great rest of your day.
So Hydrate ended up being down 23 cents today. I didn't write down everything, but the two takeaways that I would say to a new person is their VHD1 platform basically allows for recurring revenue in perpetuity for a lot of customers as far as services that they would need continuously, like testosterone replacement therapy, hair stuff, injections, GLP-1s, weight loss, peptides, all that stuff. Um, that makes a lot of sense to me. The other thing that is very interesting for me is that as they get more licenses, those licenses not only have a recurring revenue for the licenses, like a subscription fee to work with their company, but those licenses provide many benefits and revenue toward the company because they funnel revenue from patients to the pharmacy platform or other platforms for other services and make money that way. The other thing that's interesting is as they add more services, it almost like backdates every single license and updates it as a almost like as an asset. Like it's like updating a property. I've had this property for a year. It was making, $5,000 a month or whatever. So if you raise the rent on that, you get more money. So it's like each of these licenses, as new services become allowed to be utilized, each license will add revenue, which is amazing. Like they're going to be adding several thousand licenses every year, but as they add new services and licensees take advantage of that, the revenue growth from that will be much, much greater. Because instead of having to acquire new licensees to add more money, existing licensees will produce more, which makes a lot of sense to me. HYDTF today was down a hair. It jumped up a little bit, then jumped down a little bit. Still definitely within the, I'd say that the $2.60 to 70 cents is a little bit of a support. I'd say that the $3 is a little support and resistance too. And hopefully we don't go all the way back down there, because even though I'd probably buy more, I don't really want to. I've got a big position already. So, yeah, things are going well with the HYDTF. Any other fun things happened? SLNH had a nice little pop going from the 80 cents up to 160. Then we went down all the way to almost below $1 for a hair. Now we're back up to $1.60 again. If you're a swing trader, this is a pretty nice place to be in. I'm noticing some nicer positive volume for the last couple weeks. So as the AI trade gets better and we approach the end of the year, I think SLNH will do a lot better because their issues are debt and ramping up to profitability with their AI data center stuff. So I'm not saying these are a forever trade, but I do think that a couple thousand shares into these guys going back up to the 5 range, you get 3,000 shares, it's 80 cents. You go up to $5, you're looking at a $12,000 or 3, 4, 500% gain. Anyway, we could go over all that stuff another time. I just wanted to look at I was expecting a more interactive earnings call with, all of their slideshows that they had on their website, but I guess we can worry about that later. So very positive earnings call to me. This will be a make or break year because even though HYDTF has been showing very good growth, they basically peaked last year, hitting just under $4, and pretty steep decline, pretty steep incline. But until we get that revenue, we got the whole, we basically need to have beaten raises a little bit this year to get that price up. Let me just check out something real quick. I did some research into valuation and price. So let me pull that up. It's just taking a moment. Okay. So if the revenue is reaches 150 million, the multiple these guys should be getting should push them to about $7.50 to $10 for this year. That's if, near the end of the year, once we start proving the revenue is coming, and that could be higher if, the revenue is more like 160 or 170. That's good. If once we get past $4, once we get to a higher price on the stock, $4 or $5, they basically qualify price-wise to get uplisted to the NASDAQ. For the next year, they also have a buyback program in place to buy back 10% of their existing shares. So whatever earnings and revenue or sales they're getting is going to increase by close to 10% based on that share buyback. And they actually have the cash existing to do that now. Their cash from operations are growing very rapidly. 2027 price outlook, if they got if they got included in the NASDAQ, if they became a, not an over-the-counter stock, but traded on the NASDAQ, their revenue went between 250 and 3 million, we'd be looking at a $16 to $20 stock. 2028, still on the NASDAQ, and if their growth continues for those 3 years or accelerates, we could be looking at between like $30 to $35 stock. And this is all dependent on if their growth remains consistent. So, we'll just have to see. But I did a lot of research into comparable companies to HYDTF. I basically was looking for companies that are around their size, that are growing this fast, that have zero to no debt, that are doing share buybacks, that have free cash flow. I mean, basically all of the things that make HYDTF special, not like their business itself, but like the characteristics outside of that that are signals that they're a strong company. Most companies do not do buybacks when they're this small and when they're just reaching profitability. I think the reason why they're doing that is one of two reasons. First of all, I think there's probably a lot of shares held by the company and the owners, and they want to use the company to buy back shares because they foresee this company kind of going up quite a bit. So the more shares they can buy back at this point, taking about 10%, or even like in 2 years, if they can do 20% of the stock buyback if the thing is low, then we're looking at a company that's got 40 million shares. That is very small compared to how big they could get. 40 million shares, and the revenue gets up to 400 million. I mean, we're looking at some pretty big potential numbers. No guarantees, not wanting anyone to ape in. I mean, if there's a pullback and you want to buy, that's up to you. If you want to buy it up here, that's up to you. I don't know. My position has been already done back here, and then I added more in the lows right here. But after I added down here and it's recovered, I'm like, I'm done. I'm getting into other things like Zeta and a couple of the cheaper new companies I was telling you about, like HealWell and Data Vault. And I did end up buying Synergy around 31 cents, 31 and a half cents. No, not 31 and a half cents, 30 and a half cents. Well, not 31 and a half, like right. It was 31 or below 31, like it was kind of in that area. But well, it wasn't today, it was the previous day. Yeah. Yeah, this was the day when that range was pretty low. This is the day that I bought. I bought a couple thousand shares. By a couple, I mean 10,000. So hopefully they have a nice rollout. This is not going to be, Synergy's not going to be a forever stock for me. It is just if their beverage rollout does well and they can get back up to $2-3, by the end of the year, 10,000 times $3, it's 30,000. I can sell, a third of the position, and 10,000. Yeah, if I sold 3,500 shares, that's basically getting all the money back. And then I can let the rest of it ride and see if they grow a little bit for the rest of the year or in the next year if their beverage starts doing well. And if they expanded other lines, who knows? I'll have to do more research at that point. But this is certain things are trades, certain things are long term. Um, Stuff in the Roth and the Dunda Market Index, this stuff is more long term, although there are some trades in there. And a lot of these things are not owned anymore. Although, here's Sprouts. I had long calls on PayPal. And where's Sprouts Farmers Market? Yeah, boop. Yeah, when these guys dipped down to here, I had year out calls to buy it, I think 70 or something, or get, and it was pretty cheap. And I think seeing it go up was nice, but then seeing it come back down, I think I sold them, you know, I lost a little bit of the volatility, but I think they were still in the positive. But these are guys I wanted to sit and hold on to, but I just wanted to divest, especially with the, the technology stuff growing. But I don't know. That's okay. But yeah, Sprouts Farmers Market, I think will do well. Cake should do well. Like I was in Celsius for a while, but I did get out of it. It was a good thing to trade and sit in. You know, you sell when it gets high, buy when it drops, and then wait for a while, get out of it. And this is a great options company. And I actually bought some down here, and I think I don't know where I sold it, but I bought a small position, and then I was just realized, you know what? These guys may not do well. I mean, they may, but I think that I saw some news that they got like kicked out of Walmart or kicked out of Costco or something. They lost a big retail outlet, and in the short term, that's going to be difficult to overcome, and they may be fine, but I don't know if they will ramp up and go up again in the same way that they did for a while, um, decreasing earnings and losing that retail outlet. I think it was Costco. But anyway, yeah, like a lot of stocks in here I don't own, but I sit in, and yeah, there's 4. I did buy a position in there, but anyway, um, yeah, we'll end the video there, and I hope all you guys have a good time.